Happy Independence Day. So I'm super glad to be an American. You know, a huge percentage of the globe today have many of our same freedoms, but that is largely because of our leadership as Americans and our willingness to fight and die for their rights to those freedoms. I know some are chiseling away at our freedoms right here, even the freedom of speech and expression. But America, right now, the United States, we have the greatest freedoms from oppression of government anywhere in the world. We even still have the freedom to try and fail. That's my favorite of all. All right, listen, I've got a bit of an unusual episode today. We're going to look over a bunch of economic writers' thoughts as we go into the second half. There was an awful lot of people talking about what happened in the first half and what's going to happen in the second half. I think what I'm going to tell you this morning is going to uplift you. And then, of course, we will look at some Tesla news. This is Randy Kirk, in case you hadn't figured that out yet. And if you could that's always going to be a big help. Watching to the end. Did you know that? Did you know that watching to the end helps my algorithm? Even if you're bored to death, just, turn off the sound and let it run to the end. Anyway, hit subscribe and notify. I got Larry Goldberg coming back this afternoon. He is going to be talking. Well, I'll tell you at the end what Larry's going to be talking about. And then, of course, thank you. A couple of Patreon folks. Another one signed up yesterday. I certainly appreciate that. And that's a big help to the channel. All right, let's take a look here. Okay, this first one is from the Wall Street Journal. Consumers expect to see 4.1% inflation a year from now. That's wrong. They're incorrect, but that's the lowest such reading in 2 years and down sharply from its recent peak of 6.8%. This is according to a median response from the New York Fed's May survey. So this comes from the Fed saying that they told Americans, we in the United States believe that inflation is on the way down, but they're thinking it'll still be 4.8 a year from now. I don't think so. But anyway, more important to the Fed, this is quoting again, consumers expect inflation to ease to 3% in 3 years and to 2.7 in 5 years, the survey found. Well, again, I disagree with the average American's view of where inflation is going to be, but at least it's heading down. That would be around the 2.8% average of 3-year expectations during the 5 years before 2020 when the pandemic hit. During this period, the Fed considered long-term inflation expectations to be stable or anchored because they moved very little in response to short-term events. Other survey results vary in specific numbers, but generally show the same trends. So basically what they're saying here is if the Fed is paying attention to this, Americans right now believe that inflation is at about the same levels and in the future will be at about the same levels as they did pre-pandemic when the Fed was fighting to get inflation up to 2%. So this should be one more clue, one more cue, one more way for the Fed to be able to say, look, everything's fine. We don't need to raise rates. I hope they're paying attention. Okay, from Fox Business. As the Federal Reserve considers future interest rate hikes to reduce inflation and consumer spending remains high, the nation could soon slip into a recession. This is according to Fannie Mae Economic and Strategic Research, the ESR Group's latest economic and housing outlook report. They expect the continued tightening of credit conditions, slowing bank lending, and shrinking money supply will eventually lead to a downturn in business investment and hiring, eventually leading consumers to pull back on spending, coinciding with a recession. All right, that was not very uplifting, huh? So this group still has this mindset that we're going to see this tightening of credit conditions, shrinking of the money supply. Now, I've talked about the shrinking of the money supply. I think we do need to pay attention to that. Hopefully, the Fed will stop reducing the money supply in time. Anyway, they go on to say, while continued labor market strength suggests no imminent downturn, employment in general is a lagging indicator. That's true. And there are some signs of weakening. The ESR Group said that its May economic forecast report, that was when they reported this, job openings have declined by more than 1.6 million over the past 3 months. Temporary employment, a generally leading indicator of broader labor market trends, remains in decline. Furthermore, continuing unemployment claims, though still low at an absolute level, have been trending upward. All of those things are true, but all of those things We still have 3.5, 3.6% unemployment. I'm sure that's going to be reconfirmed this coming Friday. We still have 10 million jobs out there and only or a little over 1 million people that are long-term unemployed. I'm sorry, I don't think I can agree with this. Okay, so how about this? Someone else has joined the gang that includes me and Kathy Wood and almost nobody else that thinks that the inverted yield curve is not about a recession. This is Brian Swint in Barron's, and he says, the current abnormality stems from expectations that the Fed will keep raising interest rates for now. So the 2-year yield has risen to almost 5%, the highest since March, from up around 3.8% in April, after data showed economic strength that could give fuel to inflation. And he goes on to say that, but the market believes that long-term inflation is under control and the Fed will have to lower interest rates. That's why the 10-year bonds are so low. So anyway, it's nice to see somebody agreeing. That's 3 of us. I think if I talked to my mom in detail, she would agree with me too. All right. Anyway, then we have from Market Watch, we got Brent Aarons saying this: at the start of the year, the top forecasters were predicting the S&P 500 would have a bad first half and the U.S. would slide into recession. Reality, the S&P 500 turned in a stellar 6 months, rocketing 17% in 6 months. Where do you get returns like that? 34% per year. And they said the index would end 2023 at around 4,000. In reality, it's already near 4,500, higher than all but one of 17 forecasters expected for the full year. All but one. What about those forecasters forecasting Tesla? Anyway, he goes on. As for the recession, we are still waiting. Back in this is devastating. Back in January, the street's top money manager said the U.S. stock market would be a terrible place to be in 2023 and way worse than Europe, Japan, or best of all, emerging markets. In reality, so far this year, the S&P has beaten Europe, Japan, and emerging markets. And emerging markets, the big money manager's top pick so far this year has been the worst region, gaining just 5%. Nice that it was up 5%, though. 10% is still 10% a year is still good. Well, it doesn't end there. At the start of the year, the world's biggest money managers also said that you would be much better off in cash and treasury bills, commodities and hedge funds than you would be in stocks. Quick, name 3 assets that have been much, much worse investment so far in 2023 than stocks. Give up. Cash and treasury bills have earned you less than 3% interest. Commodities are actually down 8%. As for hedge funds, the HFRI Hedge Fund Index says that through the end of May, the average hedge fund investor has so far earned 0.3% this year. No, that decimal point is not in the wrong place. Nor does it end there. Among the few sectors of the U.S. stock market that big money crowd actually liked back in January were energy and banks. Energy stocks are down around 5% so far this year and worse than almost every other sector. Apart from that, you guessed it, banks. The SBDR S&P Bank ETF has managed to blow 19% of your money in 6 months, thanks in part to the risk management departments of Silicon Valley Bank, among others. It's yet another reminder that you won't get rich from following the smart crowd. You love that ending? Yeah. Follow the YouTube guys. I think we've been more right than they have. All right, here's a little bit of Tesla news. Tesla has changed its standard paint color for the Model 3 and the Model Y. Now, everything but midnight silver is at least $1,000 extra. Actually, our Tesla Model Y is, I'm not sure it's midnight silver. It's one of the dark gray. I don't remember exactly what that color was called at the time. Anyway, and then VW says they blame their EV production cut on strong consumer reluctance. I've been in sales and marketing for many decades. I've worked in many different fields. I can't begin to tell you. My clients have included, are you ready? A chimney sweep and the #1 breast cancer replacement surgeon, plastic surgeon in the U.S. And in all of those, I've never had, not my companies, not their companies, I've never had anybody bemoan the fact that they were facing strong consumer reluctance. That is a new one. Okay. Anyway, how about these numbers? Li Auto's estimates, Tesla China appears to have seen 17,400 insurance registrations in the week ending July 2nd. That suggests the electric vehicle maker ended the second quarter on a strong note. That was a 4% improvement from the 16,700 registrations ending the week of June 25th. So up 4% just in a week. If we multiply that times 4, you're looking at almost 80,000 vehicles again for the month. Anyway, let me remind you again that Larry Goldberg will be here with me. What's Larry going to discuss? We're going to go through the major aspects of the Tesla story that will move the stock the last half of this year. And then I'll be back later in the day, sometime probably around 4 o'clock, 5 o'clock Pacific time. And I'll review what's coming up the rest of this shortened stock week. We'll talk about the markets. We'll talk about the reports that are going to be coming out the rest of this week and what impact that might have on Tesla stock. So hit subscribe, hit notify. If you liked what we talked about today, hit the like button. And then, of course, Patreon is sitting there. All you got to do is go down into the description, hit the link, and go over there and sign up for $5 a month. Is this channel providing you $5 a month worth of value? Please help out the channel and then buy the books. Hey, it's been great talking to you. Again, happy Independence Day.